Good afternoon, all. Uh, I welcome you to our today's webinar on related party transactions. On behalf of Institute and all panelists, I welcome you all and thank you for joining us. Uh, Friends, today we are fortunate to have three legends. I would say they are three intellectual mentors, at least not only for me, but for many of us. Mr. Sudhakar, he needs no introduction. The kind of intellect, the kind of practical insight he has on this subject, particularly, and many other subjects, is exceptional. And that's how we keep troubling him and we keep requesting him to join. We are also joined today by Mr. Makan Joshi from Mumbai. He also, again, no introduction. He is always available for Institute. Third panelist for the day is Mr. Sundar Singh. Thank you all, three of you. I'll give their introduction in a meanwhile. I think today's webinar certainly holds a lot of relevance, particularly from the perspective of the timing at which we are organizing this. As we all know, related party, somehow I feel there's a taboo attached to related party transaction. A related party, there's something wrong with it. I remember many years back, I was arguing a matter in CLT. The transaction was that the parent, that 80% shareholders entity lent some loan to the company for its daily operational purposes. That 20% shareholder was erring. He was not contributing, so 80% shareholder had to introduce fund money so that the company can incur the daily expenses. The 20% shareholder filed operation disbandment petition. The court asked and challenged that this money which was later on was converted into equity, because loan was converted into equity. And, I remember NCA judge asked me a question that, Mr. Chawla, how can you justify this transaction, that the 80% shareholders lent some money and then later on they convert that into equity without taking approval from the 20% shareholder. Now I answered it in three ways. I said there is a taboo attached to related party transaction. Every related party transaction is not bad per se. Every related party transaction is not disadvantageous. A related party transaction is disadvantageous and must be restricted and stopped when it hampers the interest of the company, when it creates a prejudice to the interest of the stakeholder. It is done with an intent. I will not name. I am already matters in SAT, where certainly there were related party transactions which one authority or other has checked later on, particularly from the perspective of listed entities, that when the listed entity is routing money from one entity to another, and then routing it back to the main parent entity in one way or other, whether that's permissible, obviously not. And with this perspective, I think related party transactions, if we follow two principles, day before yesterday, Satvinder sir was also available. I dragged him into that conference because in the office, two were on one side, one was on another side. So the transaction was that the board and shareholders are same. Board has already approved the transaction. There was a issue whether we should go ahead with the executing the transaction or shareholders approval is required. Stricto sensu, no shareholders approval required. Tomorrow, if the again challenges the transaction, the answer which we found amongst us was that the deemed approval of shareholders is already given, because the board and the shareholders are same, the constitution is same. So and moreover, the transaction was being done on arm's length. So I feel the taboo attached will have to be seen from this perspective. And your own institute came out with a note on 2019, which is under revision presently, and that's how we thought to organize this event. Today's webinar is aimed to get your suggestions. It's for you. And the suggestion is, and my advice is to all the participants to please keep sending us your questions. How will we proceed in today's program is, first we'll have 20 minutes presentation by all the three panelists. We'll start with the Dronacharya of intellect, Dhakar sir, who will for 20 minutes give a brief presentation. And whenever he is there, I certainly know. Although today has been a busy day, initially in the morning there was a meeting of the amendment committee. Then I'm joining from a hotel in Noida. We are here to speak. In fact, I've just finished my session. Couldn't do lunch. Thought to have this intellect lunch today instead of having the normal roti chapati. And for 2 hours, and probably in the evening, it's sir will sponsor the dinner. So the first 20 minutes presentation will be given by Mr. S. Sudhakar, who is a former Vice President of Reliance Industries. Sudhakar sir is a fellow member of the institute. He is also a qualified secretary of ICSA UK, law graduate from Mumbai University. I will always call him a Delhiite. He may be a South Indian, was working for many years in Bombay, but from heart he is a Delhiite. Most of the time he in his professional career in Delhi. So I'll always call him as a Delhiite. He has been helping institute in many capacities as an active member of the Secretariat Committee earlier and vice chairman presently of the expert group on secretarial standards, and the kind of discussion which they do. Uh, Fortunately, Satvinder sir is part of it and chairing as the chairman of the as the expert group. Unfortunately, maybe I need to get free from few other activities, and then they will give me an opportunity to let me share my views and learn from them. And he is always a regular faculty at all our programs. Thank you, Sudhakar sir, for to our request. Always a learning for me. Our and Sudhakar sir will today address a very relevant topic, which is again, I was speaking to my partner Lokesh Dhyani, whether a particular transaction is a related party transaction or not, and the definition itself needs to be interpreted in a very careful manner. He will take us through. Sudhakar sir will take us through today the definition of related party and related party transaction as well. And obviously, the background and the idea of having today's program is not on all background of the related party transaction, but from the amendments which took place from the perspective of the listed entities and the SEBI's amendment which were brought in. The second speaker for the day, and if you really ask me, I love the persona which Makran sir carries. God is kind. He's available with us again, fully back in track. He was a bit unwell for time, and really missing him when he was refusing her for very short period. But I am so happy to see him again back in full form. Mr. Makrand M. Joshi is a fellow member again, partner of MMJC. MMJC, friends, is probably the biggest practicing company secretaries firm. More than 150 professionals there. I have not seen any mega firm than his firm. So need to learn a lot of things from him apart from his intellect, but how to grow big is one thing which I certainly many learn from Makran sir. Apart from his pleasing persona, he has extensive knowledge and expertise in corporate governance and various subjects of company law matters. He is actively contributed in research committee, written many articles. He has won the best secretarial auditor award from ICSI in 2019-20. Fortunately, I was the chairman of the committee that year, corporate law governance committee. I was able to give that award along with him, and he deserved that award. He is very active member of the expert group of secretary judge, and he has also been convening CSI, SSB publications and guidance note on PIT and guidance note on CSR as well. Thank you, Makran sir, for sparing your valuable time and agreeing to be with us. The last panelist, certainly not the least, closest to me, I would say individually, because I am what I am because of my parents, God, and then him, Mr. Satvinder Singh, who is again a fellow member of the institute, former Central Council member, past chairman of NIRC. And it will be difficult for me to stop myself if I start introducing him the manner I want to introduce him. Short introduction is that he was partner in a law firm for 25 years. We have, Satvinder sir, me and three more partners who were working with us and part and parcel of our life now, have formed a law firm called ACOM Legal, based in Delhi as of now. And he has extensive experience in handling all corporate law matters, merger. We say that merger, amalgamation, corporate restructuring in his blood, next to his wife, uh, closest to his heart, is now secretarial standards, these related party transactions, these guidance notes. He's still today in office, deliberating with other colleagues on many aspects. Mr. Singh is also presently one of the members uh, who has been appointed by Government of India on the appellate authority constituted under CSES and CW. Uh, and that's the brief introduction I can give. He has authored many books. Thank you, Satvinder sir, for agreeing to be with us today on short notice. I'm sure today's deliberation will take us uh, many years ahead from where we were earlier, particularly in the discussion on these aspects. I think we have formed some questions. Few more questions we'll receive. Sudhakar sir, I think without much ado, I could request you to start with your presentation for around 20 minutes, and then followed by Makaran sir, and then Satvinder sir. Followed which, then I'll take up few questions which we have already prepared, and then many questions we have already received from members, and then we'll take it forward from there. Thank you, Sudhakar sir. Over to you.
Yeah, thanks very much, NPS, for that warm introduction. And at the outset, my sincere thanks to the ICSI for organizing this webinar, as well as inviting me and Makarand as well as Satvinder as panelists, because we are in the process of revising the guidance note as mentioned by you, and looking forward for fruitful discussions. And also it depends upon the participants how many questions, how they are going to grill us, and so that whatever the questions are there, we are going to incorporate in the revised guidance note. At the same point of time, let me also assure you that we will definitely take care of your intellectual hunger. I'm going to give you the starters. Main course will be served by Makarand, and the dessert will be served by Satvinder. So with this assurance, let me make a small presentation. I have brought it, and which I'm going to share with all of you. Because today, as discussed among the panelists, I am going to deal with only two definitions, that is related party as well as related party transaction. In fact, I think this is first time, this is a webinar of this kind, where we are talking only the definition, that also only two definitions, nothing else apart from the two definitions, because the kind of importance what these definitions have as far as the compliances are concerned, it is really mind-boggling. If we understand the definitions, that means the foundation has been laid down, and then we can think of going further. I'm sure you are able to see my presentation. Thank you. Yeah. So let me put a disclaimer that the views are expressed my own and not of the expert committee on secretarial standards or of the secretarial standards committee on which I am a member. I'm not representing these two committees here. If I take the insight of RPT, there is a general presumption that whenever we are preparing the financial statements, the transactions, what we have been reflected in the financial statements, they have been entered between the parties, between the company and other parties with whomever it is dealing with. All these transactions have been entered on a fair pricing and arm's length basis between the independent parties. That means no undue favor or advantage has been given to any of them. Nobody has been allowed to take advantage at the cost of the company as well as at the cost of the shareholders. That is the general presumption what it always go while the preparation of the financial statements. However, this presumption is not valid where the relationship exists between the company and other parties with which it is going to deal with. Because the moment there is a relationship, it is per se, people presume that there is an scope for undue advantage to be given or to be taken. Not necessarily always the advantage is to be given only, sometimes the advantage may be taken. Both the things are not good. Neither advantage is to be given nor advantage is to be taken at the cost of the company or of the shareholders. However, whenever or wherever there is a transaction with related party, there is a scope to give benefit, and with and this presumption is always there unless until it is established. That means, as company secretaries, we have to ensure one thing: whenever there is a related party transactions are there, which especially where the stakes are high, when you are entering into related party transactions, where the stakes are very, very high, it is always advisable to keep appropriate documentation, because by merely saying that you have not given or taken any undue advantage or any kind of benefit, you are maintaining arm's length pricing, blah, blah, blah. Merely saying is not sufficient. You should be able to establish when the regulator comes for any kind of questioning, for which definitely there should be a kind of documentation which is to be maintained. Sometimes we take that it is arm's length distance and the ordinary course of business, and that's why we are exempted from 188 and so on and so forth. Makarand is going to deal with what is arm's length and what is ordinary course of business. But merely by saying it is not so, you have to also, because every transaction, especially other than the routine and ordinary course of business transactions, whenever you are having one-off transactions which are material in nature, I'm not talking about material means legal terminology, I'm talking about important transactions, bigger transactions, larger transactions. That point of time, what happens is one has to be very, very careful under what assumptions you have taken while arriving at any kind of interpretation. It is always advisable to prepare a file note for that. Are related transactions bad? As NPS has rightly mentioned, related party transactions per se, neither they are bad nor abusive in nature. However, there is a scope definitely there to abuse such transactions, because then, okay, you may give, you may take, something like that. Related party transactions, they have sound economic rationale and can be value enhancing also. So hence there is no need to prohibit the related party transactions as such. Related party transactions, as I was mentioning, per se, they are not bad. So there is no need to prohibit the related party transactions. However, considering the scope of and experience of abuse, because the regulator always regulates and they make the regulations, whether stringency is to be brought in or not, it all depends upon his experience. The regulator felt that the related party transactions, the way the scope is there, it is being taken advantage or it is being abused by some companies. So it has been felt that the regulatory framework is to be fortified and to mitigate the possibility of abuse. Now, what are the provisions applicable? Just to mention about that, whenever a related party transaction is to be examined, as we all know that if it is unlisted company, we are concerned only with the Companies Act 2013, all applicable to all companies, both private as well as public companies, and the sections we have to deal with is 188 as well as 177. If it is a listed company, over and above the compliances with the Companies Act, we have to also see Regulation 23 of SEBI LODR and, of course, accounting standards. Now, how to approach an RPT? As company secretaries, for the first and foremost thing, what we need to do is whether the party with whom the company is going to enter into the transaction, is it a related party? Once that is determined, then second question will come. So in the first step itself, you have to see that, is it that party with which the company is entering into a transaction, is it a related party? For that, you have to follow back upon the definition, that is section 2, subsection 76 of Companies Act. And in case your company is a listed company, regulation 21ZB of LODR. Once it is determined that the other party is a related party, then the second question comes is the transaction which you are entering into with that other party, with the related party, is it a related party transaction? Again, for the related party transaction, you have to fall back upon section 188 subsection 1. There are about 6 different type of transactions have been given. And in addition to that, again, regulation 23 of LODR, we have to see that. Then question comes that whether such transaction being entered into in ordinary course of business under arm's length, if it is so that the companies are exempted from the applicability of section 188, but however, in case of a listed company, such exemption is not available. So it is only for unlisted companies the third step will be applicable. Otherwise, it is not required. Obtaining shareholders' approval for related party transactions is a task of its own because related parties cannot vote on the said transactions. So most of the listed companies, they do face a problem because the majority of the minority have to vote for the related party transactions. Because of this, several companies have taken some kind of a round robin things like establishing complex group structures, including subsidiaries. The transactions have been dealt through the subsidiaries so that the main company, it is not at all coming on the surface. So regulator felt that this is one of the things which need to be taken care because the transactions are not coming to the surface. The transactions are being taken place beneath the surface only. And then increased concerns, of course, about the siphoning of funds, money laundering, round tripping by listed entities. There are several things have happened in the recent past, which we are aware of, but we are not going to discuss about that. So taking these major two concerns, SEBI has constituted a working committee to review and to make some kind of recommendations as far as the fortifying the mechanism of related party transactions. The terms of reference given to this committee are review the policy space, review the provisions relating to related party transaction and listing regulations, specify a format for disclosures. Here, compliance is not sufficient because the disclosure is also equally important in case of related party transactions. So it was felt the amount of disclosures what are to be given on quarterly basis is not sufficient enough. So there was no format earlier which have been recommended by a format now which has been notified also, and recommendations for strengthening the monitoring and enforcement of regulatory norms. While making the recommendations, the working committee has taken the following also into consideration. Number one, they have to enhance the transparency among the related party transactions. So enhancing the transparency is one important thing. So that's why SEBI has also notified the amount of information what is to be placed before the audit committee while it is approving the transactions, the amount of information what is to be disseminated to the shareholders while they are approving the transaction. Then improve the quality of information the investor have access to. That is what I was mentioning about when that SEBI has notified the amount of information to be disseminated to the shareholders. Because otherwise what happens is people might be giving according to their whims and fancies about as far as the information is concerned. So SEBI has prescribed that this is the minimum amount of information which they feel it is a quality information which needs to be disseminated. Better approval process, the approval mechanism has been strengthened, and then more robust enforcement mechanism. So the working group has submitted its report on January 27, 2020. SEBI board has approved it September 28, 2021. And the amendments were rolled out through an amendment, sixth amendment to the LODR 2021. Now, what the amendments have brought in? Number one, more stringent framework has been prescribed. Widen the scope of definition of related party as well as related party transactions. And when we are scope of the related party on the related party transactions, the cross RPTs are also have been covered. That means earlier, if the subsidiaries are dealing with the related parties of the listed company, they were not coming to the approvals of the shareholders or of the audit committee or of the board of the related of the listed entity, which are required now. Related party transactions pertaining to the subsidiaries of the listed entities are to be approved by the audit committees of the listed entity, of course, subject to certain threshold limits and all. And in addition to that, one major amendment also which has come is that related party transactions are to be approved only. Related party transactions are to be approved only by the independent director or the that if it is also a related party as defined under Accounting Standard 18 or Ind AS 24. So that means for listed companies, the definition of related party is already wider than related party definition for an unlisted company. So with effect from April 1st, 2019, this definition has undergone a small change, wherein the promoters have been brought into the net, provided they are holding 20% or more of the shareholding of the listed entity. That promoter or promoter group entity will also fall under the definition of related party. Now, with effect from 1st April 2022, this definition have undergone a major change. One of the major changes that the 20% holding of the promoter has been removed. That means any person or entity, if he is forming a part of the promoter or promoter group, per se, they will be a related party. Without whether they hold any shares, whether they don't hold any shares, it is immaterial. Any person or entity holding equity shares of 20% or more, or 10% of more with effect from April 1st, 2023 in the listed entity, directly or indirectly, or on a beneficial interest basis, as provided under Section 89 of Companies Act 2013, at any time during the immediate preceding financial year. That means, apart from the promoters, whether irrespective of their holding, there now any person or entity who are having a major shareholding in the company, but they are neither promoters nor a part of promoter group. For all purposes, they are unrelated and outside the promoter group, but still, because of the major holding, they may be able to influence the decisions of the company. So they have been brought in for the first time into the net of related party definition. For this definition, what it says is 20% or more of the shareholding effective 1st April 2022 and effective April 1st, 2023, that 20% have been brought down to 10% of the holding of the company. Another important thing what we have to remember is this shareholding may be directly by that entity or person, or it may be on beneficial interest basis. As we all know that beneficial interest basis means the declarations what we have to file under Section 89. If a person is the beneficiary of the share, then he has to file MT5. Wherever such a declaration has been filed, then he will be deemed to be a related party. One good thing happened is they have not touched upon indirect holding. That means if you are a major shareholder of a company, that company is having a holding in the listed entity. Like that, indirect holding need not be covered. You have to see only the direct holding or the beneficial interest holding. Third point, what is very important is it says that at any time, that means that holding should be at any time during the immediate preceding financial year. That means to determine a party or entity as a related party for this financial year, I have to see the holding of that entity or person in the previous financial year. And that previous financial year also, that holding may be at any time, means even for a single day if it is there. Technically, that will fall under the definition of related party. Say, for example, 1st September 2021, if an entity or a person is holding, say, 20% plus, and by the end of the financial year and in the current financial year, that is 22-23, that entity is not holding any shares. They're holding 0 shares, but still for the financial year 22-23, that particular entity is a related party. This is a very important provision which one ought to take note of. The above shall not be applicable, of course, for the units issued by mutual funds which are listed on the recognized stock exchange. So what is this is already I have explained to you, so I don't need to go for this particular thing. The rationale for these amendments is a promoter may exercise control. The working group felt that a promoter group may exercise control, and actually it is so, over a company irrespective of the extent of shareholding. Earlier it was 20%. That point of time, I was really feeling that how can, and that also if you see that they are not saying all the promoters together, it said any entity in the promoter or promoter group means, suppose if there are 20 entities are there, even if only all of them might be holding together more than 20%, but still they are not related parties, unless until any one entity is holding 20% plus. But now it is good, according to me, this is a real corporate governance measure, wherein it said that promoter and promoter entities per se, they are related parties. Second, there may be shareholders who are holding majority shareholding, that means 20% plus or 10% plus, who are not part of the promoters or they are not classified as promoters, but still there is a scope for them to exercise some kind of an influence on the listed entity. So they have also been brought into the related party definition. So based on this amendment to the related party definition, what are the action points? As company secretaries, what we need to do immediately? Identify afresh all related parties and revise the list of related parties. Include all the persons or entities belonging to the promoter or promoter group. It may so happen in the promoter and promoter group, some entities might not be holding any shares, 0 holding, but still they will become related parties as per this definition. So you have to take the list of promoter and promoter group and then you have to determine them as related parties. Second, identify all shareholders holding 20% or more of the shareholding at any point of time in the previous financial year, that is 21, 22, because we are in now 22, 23. So previous financial year means it is 21, 22. Who are the shareholders holding 20% plus, and include them in the list of related parties. Then for next financial year, what you have to do is you have to identify all the shareholders holding 10% or more and include them the list of related parties for the financial year 23-24. That means you have to see who are the people holding 10% or more shareholding during the financial year 22-23. So they will become related parties for the financial year 23-24. Monitor the shareholding pattern at regular intervals to determine whether any person or entity satisfies this threshold at any point of time. So this exercise is to be an ongoing exercise, and you have to keep a tab on these people. And otherwise, if you say at the end of the year only I will do it, you may be in trouble. Procure the list of related parties from the subsidiaries. Furnish the list of related parties of the listed entity to the subsidiaries. Then sensitize the subsidiaries with regard to the compliances to be ensured, with regard to the amendments which have come in the listing regulations, which otherwise are not applicable to the subsidiaries. Because in your subsidiaries which are unlisted, those company secretaries might not be familiar with the listing regulations or with the compliances. So it is the responsibility of the listed company, the whole course company secretary or the secretarial department, to sensitize the subsidiary companies and the related secretarial colleagues about the compliances, what they have to ensure. Now let us see the definition of related party transaction. As per the Rule 21 Jet C, it says that RPT is a transfer of resources, services, or obligations between a company and a related party, regardless of whether a price is charged or not. This is a very important and very wider definition according to me, because resources, it is nowhere defined what is a resource. Everything and anything may fall under the definition of resources. Services, so where the service is not defined under the neither in the Companies Act nor in the listing regulations. So from which act we have to pick up the definition of services? Same as the case with obligations. So any transfer of resources, services, or obligations between the company and the related party, or between the listed entity and the related party, regardless of whether a price is charged or not. So that means to determine a related party transaction, charging the price is not a determining factor. It may be free of cost also, but still it is a related party transaction, and you have to go through the compliances. A transaction shall be construed to include single transaction or a group of transactions into a contract. Very wide in scope in comparison to the transactions under Companies Act 2013. With effect from 1st April 2022, it has been revised or amended very exhaustively. So RPT means a transaction involving a transfer of resources, services, or obligations that is there intact as it was, so there is no change in that, between a listed entity or any of its subsidiaries on one hand. So the new provision here is, earlier it used to be only the listed company and the related parties, whereas now listed entity and its subsidiaries on one side, and on the other side related party of the listed entity or any of its subsidiaries. That means one side you have to take my listed entity and my subsidiaries, another side you have to see related parties of the listed entity and of its subsidiaries. Means this is the cross or diagonal transactions are also falling under the definition of related party transaction. This is what I was mentioning, that because with this, most of the transactions which were happening otherwise earlier, which were not coming to the surface, now all these transactions will come to the surface and the radar of the regulators. So a listed entity or any of its subsidiaries on one hand, and any other person or entity on the other hand, the purpose and effect of which is to benefit related party of the listed entity or any of its subsidiaries. This is with effect from 1st April 2023. This is going to create further troubles for us. What is the purpose and effect? This I will discuss little after, maybe 2-3 slides I will do that. Regardless of whether a price is charged, and a transaction with related party shall be construed to include single or group of transactions in the financial year. So in view of the definitions, to understand in simple terms, Effective 1st April 2022, the following transactions shall fall under the related party transaction. Transaction between listed entity and its related parties. Transaction between subsidiary of a listed entity and its related party of subsidiaries. Transaction between listed entity and RPs of subsidiaries. Transaction between subsidiary of listed entity and RPs of listed entity. Transactions between listed entity or its subsidiaries one side and the person or entity which holds 20% or 10% of shareholding as the case may be on the other side. So these are the transactions, how you have to examine it. What are the transactions taking place with related parties? This is how these are the 5 buckets it will not normally going to fall. Whether a related party of the listed entity is a related party of the subsidiary, because recently I've been asked this question in one of the forums. By this definition of related party transaction, a question is coming up, whether related party of the listed entity is a related party of the subsidiary. Similarly, whether related party of the subsidiary is a related party of the listed entity. Answer is no. Related party definition is different. Related party transaction is different. So this cross RP transactions only are getting covered under the revised definition of related party transactions. So the transaction between the cross that means listed entities and subsidiaries and the RPs of listed entity, they are construed as related party transactions, but they are not construed as related parties of listed or subsidiaries of that. Now, with effect from 1st April 2023, this is the major one I'm going to say. Further difficulties are going to fall on the head of the compliance officers or the company secretaries. Effective 1st April 2023, transaction between the listed entity and any other person or entity, the purpose and effect of which is to benefit a related party of the listed entity or of its subsidiary. That means this transaction, what is being entered into by the listed entity, is not directly with the related party, but with a party which is not related. But that purpose and effect of that transaction is to give a benefit to the related party of the listed entity or of its subsidiary. Similarly, transaction between subsidiary and any other person, again the same thing, purpose and effect, which is to benefit the related party of that listed entity or of subsidiary. This is nothing but indirect related party transactions, round robin transactions. I have to oblige you. Instead of obliging you, I am obliging somebody else who is obliging you in turn. To understand simply, this is the one. A, B, C, there are 3 people are there. A and C are related parties. They are bringing B as a conduit to give that kind of benefit or advantage from A to C. So B is nothing but a conduit. Earlier, these transactions were not coming to the surface. Now, with this particular amendment, they are going to come. Primarily, this is nothing but the other person or entity being, this is what I mentioned, being used as a conduit to give benefit to the related party. One more thing, what one has to remember is, both purpose and effect of such transaction shall be benefit to the related party. This is to be established. Purpose or effect is not the wording, the purpose and effect the wording. If either purpose or effect of such transaction benefiting the related party is not there, then it is not a related party transaction. So various combination of transactions included within the ambit of related party transactions may be there. What is the purpose and effect? That means when you are entering into the transaction, the purpose is to give a benefit to the third party. By merely purpose is there, but effect has not taken place, so it is not an RPT. Suppose effect has taken place, but purpose was not that, then also it is not so. So both have to be there, then will be considered as related party transaction, and this is going to be from 1st April 2023. Now come to the action points as far as RPT is concerned. First, amend the RPT policy to align the same with regard to the amendments of the listing regulations. We have to see our RPT policy. Several times this question comes that whether it is imperative for me to amend my RPT policy. Though it is not imperative for you. You have to review your RPT policy. If you think that all the amendments, whatever have come, is already taken care of, you don't need to amend it. Otherwise, you have to. But most of the times, I feel that RPT policy needs to be amended. Audit committee to determine what is a material modification. In fact, it is good of SEBI or the working group. They have not defined what is a material modification, because what is material modification, like what is an ordinary course of business, Instead of the regulator defining what is ordinary course of business, they left it to the companies to define or determine what is ordinary course of business. Same is the case here also. They left it to the audit committee to determine what is a material modification. Identify the list of RPTs and identify the transactions currently being undertaken with the related parties as per the revised related party list. That means, as on date, several parties might have fallen under the definition of related parties with whom you are already dealing with. That means the transactions are already being entered into. And these transactions may require prior approval of the audit committee, may require prior approval of the shareholders, that you have to see that. Identify the related party transaction of all subsidiaries, identify the material related party transactions or any material modifications to the RPTs which have been made to obtain, and then you have to obtain the shareholders approval. Identify the ongoing related party transactions which might be falling in under the definition of material related party transactions. Some people are under a wrong notion that the transactions which were approved earlier, though they are not falling, now they are falling under the material related party transactions because already they were approved by the board and audit committee earlier. I don't need to take the approval because regulation 23, sub-regulation 8 is still there. What it says is all the ongoing related party transactions, if they are falling under the definition of material related party transaction, they need to obtain the shareholders approval. Thank you very much for your patient listening, and then we will take the questions at the end of all the panelists' presentations. Thank you very much once again.
Thank you, Sudhakar sir.
Thank you. Thank you.
And it was lovely listening to you. I felt like you should go on and elaborate more. You should have been given more time. But yes, Chawdhury. Yes.
Yeah. Thank you, Sudhakar sir, for laying the context so well. And now we have Makran sir. Please throw more light now in the continuation of Sudhakar sir, and then we'll have questions after Satvinder sir's presentation. Over to you, Sudhakar sir. Over to you, Makran sir.
Yes, and ordinary course and arm's length. So we are at arm's length anyway because you are in Noida and I am in Mumbai. But the transactions with related parties needs to be at arm's length is the expectation of the Companies Act. Now, if we look at the structure, both the regulations had the same intention. What is the intention? The intention is actually that if you are entering into related party transaction, it should be in the best interest of the company. Now, this was not coming out anywhere, which started coming out first in CARO and then in SEBI LODR regulation when they say that minimum data to be placed to the audit committee, they talk about justification of the related party transaction. So the intention of Companies Act and LODR both had the same intention that the transaction should be in the best interest of the company. To achieve this, both have adopted a different route. Although both the regulations expect that each of the related party transactions require approval of audit committee, LODR doesn't stop at that level, and they say that even if the transaction is approved by audit committee, even if the transaction is ordinary course and at arm's length, still if it is a material transaction, then we will have to take it to the shareholders approval. They are not depending on ordinary course, arm's length and audit committee opinion also, if for the transactions which are of a material nature. And Sudhakar sir has very elaborately explained us as to how those regulations with respect to materiality are changing, have changed from 1st of April 2022 and thereafter from 1st of April 2023, how this scope is increasing. As far as Companies Act is concerned, they are relying on three shoulders. One is audit committee and two is whether the transaction is at arm's length and ordinary course or not. But that has been a subject of interpretation, and like Sudhakar sir had mentioned in the beginning of his chat, that many times people simply mention sometimes in the audit committee agenda or in the shareholders meeting explanatory statement that the transaction is in ordinary course and arm's length. But how did you came to this conclusion is the most important point, which audit committee will have to establish, which the board of directors will have to establish and also communicate to the shareholders is the new requirement under LODR. Taking this discussion further, ordinary course, although LODR does not talk that the transaction should be in ordinary course and should be at arm's length, this is an underlying assumption this is an underlying assumption from audit committee and from the board of directors that transactions should be in the best interest of the company, and therefore it should be generally in the ordinary course. If not in ordinary course, at least at the arm's length. And if not at arm's length, it should be how is in the best interest of the company. That's what the philosophy of LODRE. As far as Companies Act is concerned, they expect that the transaction should be in ordinary course and arm's length. And if it is neither, if it is not in ordinary course, or not in arm's length, then we require shareholder approval. And then there are some threshold limits like 10% of the turnover and 10% of the net worth, depending on which of the 7 transactions which are listed in 188 you are entering with. So what is ordinary course has been, if you look at Companies Act, there are many sections. Now, these are few of the sections which I have shared, where the word ordinary course is coming. For example, 67 or 117 or 179 or 180 or 185, if you look at, it talks about generally lending, giving guarantee, providing security, and it revolves around lending, that is giving loan or providing guarantee or providing security for those companies whose ordinary course of business is giving loan, guarantee, security, which are generally banks or non-banking finance companies, or they have extended 186 if you refer to the extent to say insurance companies or housing finance companies. So all the provisions like 67, 117, 179, 180 or 186, it is about, and even 189, which talks about collection of bills of exchange. It is about banking companies or those companies who are in this financial service domain. The ordinary course of business word which is coming in 188 is much wider than what is mentioned in 67, 117, 180, 180, 185, 186 even, and even 189. It is much beyond, and we can relate that ordinary course terminology to 193. 193 is about one-person company. They say that one-person company entering into contractor other than in ordinary course of business will require following compliances. So 193 also uses the word ordinary course of business. 188 also uses the word ordinary course of business. And the 67, 180, 185 also uses the ordinary course of business. But in 185, 67, this ordinary course of business is pertaining to loan, guarantee, security, and therefore it is about those companies whose ordinary course is to give loan, guarantee, security. But 188, when they say that whether the transaction is in your ordinary course of business or not, many times initially people felt that whatever is in my main object, only those should be considered as my ordinary course of business. But over the period that maturity evolved, that it's not about whether it is main object or whether it is not in main object, whether it is in my normal course of business to do this transaction or not, are the parameters to be evaluated. Another terminology which 185 uses is if the money lent by you to another body corporate should be used in the principal business activity. And therefore, these questions also come in many seminars and webinars, that whether this principal business activity under 185 and ordinary course of business under 188, is it the same or not? Now, as far as principal business is concerned, RBI says that how will they be determined as to whether you are an NBFC or not? They go on to say that if your asset, more than 50% of asset is from a financial nature, and if your income is also from more than 50% of if your income is also from financial nature, then we will consider it as principal business. Whereas in NGT 7, they say that if it is any business beyond 10%, then we will consider it as a principal business. But I think 188 is much wider. Even if you are a multiple business company, and many businesses contribute to your main business, and each of it some may be 5%, 10%, 20%. It doesn't matter. As far as 188 is concerned, it is not necessary that the money which is the transaction is for the business or for the vertical which is contributing only 8%, then it will not be considered as ordinary course of business. That kind of view we did not take in as far as 188 is concerned. And these things I thought will be very important. There are some tax pronouncements which we have covered in our guidance note, which was released earlier with respect to related party transactions, which is undergoing a change now under Sudhakar Sir's leadership. First is Bharti Televentures case, where income tax said that it is not only necessary that it should be in your memorandum and article, but you should be regularly undertaking those activities on ad hoc, one-off transaction should not be considered as ordinary course. Or Sixaria Biswan Sugar Factory said that giving loan may not be considered as ordinary course of business. Or a South Indian Pictures Limited said that if entering into contract is an ordinary course, then cancellation of contract should also be considered as ordinary course. So income tax has dealt with this ordinary course at length. Now IBC is dealing with ordinary course in many pronouncements. For example, JP Infra and Jayaprakash Associates, where they have threadbare laid down as to whether a particular transaction will be considered as a preferred transaction and whether it is a fraudulent transaction. By determining that, IBC uses the word ordinary course, and therefore we will see judgments and pronouncement as to what is ordinary course of business under IBC level. As far as Companies Act is concerned, 188 has not been subject of jurisprudence so far at a great length. However, now section 188 will be covered under adjudication mechanism, and soon we may start seeing the adjudication orders upon this particular section, and that will also educate us about what's the regulatory view with respect to ordinary course of business. Now, these are some of the examples which whenever you are entering into such kind of transaction, definitely you should ask this question to yourself and to the management. And like in the opening remarks, Sudhakar ji also mentioned that it's not only that you mention why it is in whether it is in ordinary course, you also mention why you consider it is in an ordinary course of business. And if this why is recorded in the board meeting notice agenda or the audit committee meeting notice agenda and minutes, then it will be great savior, not only for the independent directors, but also for the promoters and also for the KNPs of the company. So for example, sale or investment of the subsidiaries, if you are doing to a related party, definitely you will have to substantiate why do you consider it as ordinary course. And by default, a public perception or the regulatory perception may be saying that no, it's not an ordinary course unless you are into investment and financial activity or giving property as a guarantee or security. Now there can be debate as to whether this particular guarantee or security is covered under 7 transactions listed in 188 or not. But if you are a listed company, then those defenses are not going to be useful, and giving guarantee or security for a related party transaction loan when the related party is not a subsidiary but some other entity where director, promoter or KMP has a personal interest. All the more we have to be very, very careful to assess whether what's the justification of this. Giving services or issue of shares against issue of shares or debentures. So any non-cash transaction, definitely it will be very, very difficult to say that it is in ordinary course of business. Or if you appoint a director or relative of a director which is a very young person and maybe less experienced directly at a managerial position, and if you are a very large organization, then also. So these are some of the, or performance guarantee or a bank guarantee given to a related party which is not your subsidiary or you do not have any economic interest. How are you going to consider that it is in the best interest? And how? So best interest and ordinary course and arm's length are linked to each other is my point, which I am trying to highlight. Having discussed some points with respect to ordinary course, now we'll discuss about arm's length. And when it comes to arm's length, and if you talk to any tax expert, he will give you 5 methods of determining arm's length pricing. And therefore, the tagline which I have given to this sub chapter is arm's length transaction or arm's length price. And this subject also, our guidance note issued by ICSI under old Secretarial Standard Board and current expert group on Secretarial Standard and Secretarial Standard Committee will be approving that. That guidance note of 2019 has specifically dealt with this particular aspect, that as far as tax is concerned, their focus is on arm's length price. However, as far as Companies Act is concerned, it's not just about arm's length price, but it's about arm's length transaction. Now, many times people ask me question, how do you differentiate or what is the difference? If the pricing is at arm's length, is there anything else also needs to be looked at? I will give you an example. If I am a hospital company running a hospital and chain of hospitals, and I have acquired some property in say Hyderabad, and I want to give a construction contract of that hospital to one company. And then one of my director's relative, one of my director's son, for example, he incorporates a new company, which is a construction company, fresh, new, Garma Garam company. Just a memorandum and article received, no credential, no background, no people, no, nothing to prove that they have track record of doing this transaction. And he gives a quotation, and there is another reputed contractor who has been doing this kind of transaction very regularly. He gives a quotation, and both the prices are matched. And if audit committee or board of director or the management decides to go ahead saying that this is an ordinary course of business and at arm's length to give transaction to a party who does not have any background or a credential, then they can put themselves into big trouble, because the responsibility casted on the fiduciaries here under Companies Act is not about arm's length price, but it is about arm's length transaction. As far as income tax is concerned, their mandate is to ensure that there is no loss to the revenue, that to the loss of revenue to the government. Whereas as far as 188 is concerned, the mandate is that the transaction should be in the best interest of all stakeholders of the company. And therefore, this point has been dealt with in guidance note issued on related party transactions in detail. And as far as arm's length price is concerned, there are 5 methods which are accepted internationally and even internally in India. And amongst those 5 methods, the question which arises as to which method I should adopt, the method which is most convenient to me to prove that it is an arm's length price, or the method which is most appropriate to this particular transaction. And the answer is what is the method which is most appropriate. And therefore, whoever is giving a comfort to the audit committee or to the board of director or to the management that the transaction is as at arm's length, and when they are saying that we have relied on X method or A method or a B method, they should also lay down as to why only this method they have applied and not other method. Generally, when we go to the doctor, they go by elimination process. For example, if somebody goes to a doctor saying that I am having a chest pain, he will directly not take you to cath lab. Or somebody saying that I have a headache, then everybody will not doubt about tumor. He will go first about elimination process. Smaller things, smaller issues or smaller diseases, he will eliminate, and only then he will go to the balanced one. And therefore, the same process. So take process 1, whether it is most appropriate, no, B, no, C, no, D, yes, D, yes. Then what is the most appropriate, that we have to select, and that justification, if it is available in the third party report which is coming to the audit committee, that will give a lot of comfort to the audit committee who is approving this transaction, because although LODR does not insist upon this particular thing, or even 177 does not say that audit committee has to look at whether the transaction is at arm's length or not. But this is a basic understanding why this transaction is going to the audit committee. It is the transaction is going to the audit committee because the regulator feels that the forum where there are majority independent director, and now under LODR what they say, only independent director are deciding about the transaction, they will get themselves satisfied that whether the transaction is really needed, whether the transaction is in the best interest of the company, and whether the transaction is at a price and the terms which are at arm's length or not. And therefore, this becomes very, very important distinguishing factor. It's not just about price, it's also about the transaction. And these are some of the examples. And for example, gifting an asset or purchasing asset higher than the market value, or anything which you do free for a related party, giving registered office for free, writing accounts for free, maintaining minutes for the free, or incurring his stationery cost for the free. Anything which is going to the free will not be considered as arm's length. So definitely all these aspects, these are some of the examples which are appearing on the screen in front of you. That for example, my borrowing cost is 5%, my borrowing cost is 10%, and my lending cost is say 7% or 8% to a related party. How will you justify that it is at arm's length? That if there is a commercial justification, definitely you can do that, but we have to be very, very careful, and that justification has to be elaborate enough, and it should be in the best interest of the company. And as it was discussed by Sudhakarji, that we have to discuss not only, it should not be just a hunch, it should not be just a trust of the audit committee, it should be documented as well. Now, what's the role of the board of director? Is definitely as a trustee, and therefore what I say many times is that whenever there is any director who is interested in a particular transaction, he discloses it, he abstains it, he is the safe person. But the other directors who know that a particular director is interested and they are taking decision whether the transaction is in the best interest of the company or not, their role becomes very, very important, and this is now codified. This is not an understanding. This is a law. Section 166 specifically spells out these as a duties, and therefore increasingly we have seen a trend in some of the recent pronouncement where there was a transaction with a related party, and one company acquired the shares of another listed company shares from the promoter, and the independent directors were questioned, and some of the independent directors were even debarred because when they saw the conflict of interest, they did not do a due diligence. They did not ensure that the disclosure was done properly. They had not followed the process properly, and therefore even independent directors were questioned about it. Whenever we see any proceeds of the fundraise, funds are not utilized by the company properly, then audit committee chairmen are questioned. Why are they getting questioned? Is because now not only that audit committee has a specific mandate, as a director they are under mandate under section 166 to ensure the director take care of the interest of all stakeholders, and they discharge their duties with proper care, diligence, and skill. And wherever there is a conflict, he should excuse himself. And whoever are approving this transaction, they have to look at 166.2 and 166.3 are the most important points which I thought I should share with you. And if the audit committee and the board of directors are able to establish that why this particular transaction, whenever there is somebody interested, if the disclosure of interest is done properly, and why it is in the best interest, why do you consider it at arm's length? If it is recorded properly, and with a rationale, secretarial standards on board meeting also say that whenever you take an important decision, also record the rationale for the decision making. And I would like to highlight, although it says secretarial standard on the board is not an agenda, but this will come again and again during the day's discussion, that its secretarial standards and the guidance note gives so much of the guidance. If you read secretarial guidance issued on independent director, there is a discussion on business judgment rule, which is arising from US law and Australian law, and those proofs and those symptoms, those these provisions we also find under Companies Act under 166 or under 463 of the Act. And if the director or the fiduciary is able to establish that he has done his diligence well, there was a process to identify related party, there was a process to assess whether it is in the best interest of the company, whether he has taken enough effort to get fully informed about the transaction, or that SEBI has given him minimum data to be placed at the audit committee, whether that data is really enough or some simple English which is coming in the audit committee. All those things, if the directors and fiduciaries are able to satisfy, definitely they will be able to claim a bona fide whenever there are questions raised with respect to arm's length or in the best interest of the company or not. And when we look at public perception, whenever we take the transaction to the shareholders, what we see is that there are certain aspects which are appreciated by the public and the analysts and the advisors of the shareholder, as to whether whenever you go to for a related party transaction, if you have mentioned the commercial reasoning for this transaction, or if you have mentioned the justification for choosing a particular related party and why not other related party, or if you have established positive credential of a related party as an explanatory statement over and above the minimum data, then these things are appreciated. And this is what will differentiate between man and a boy for the corporates who are taking the transaction to related party transaction. And therefore, explanatory statement is an opportunity for the management and the board to demonstrate their credentials and their decision making properly. Some things which are negatively looked at is, for example, if you in the disclosure, for example, in one of the transactions, they mentioned that the price is as per the contract. But what is the contract is talking about price they had not disclosed? Or whenever approval sought for all the transactions together, then many times people are raising question as to how do I determine whether it is in arm's length and in the best interest? Please explain us bifurcate those transactions. Although you may club, now this will be Satvinder sir will take in his next agenda as to which transactions will go to the shareholder. You may club all the transactions like purchase, sale, service, and other transactions. You may club for determining 10% threshold. But amongst those, what is the individual limit and what is the individual credential? That if we are providing, then that is appreciated. This is one, before I end my talk, sometimes I have seen these cases, and we were discussing, Satvinder sir, you will recall this discussion. Sometimes one company is giving, related party is giving security for the loan availed by a listed entity. Now it is in the best interest of the listed entity that promoter is giving him security. But if it is material, then it will require, whether it will require shareholder approval under materiality threshold. I will leave this line to you because we are going to talk about which transactions will require approval of board and shareholder, and that's it from my side. Thank you. Yes, Stephen.
Thank you, Makarand, for raising that issue. Probably
Yes,
I'll
sir.
just, yeah.
Thank you. I hope, Makaran sir, what you are saying, the examples between hear it because of the network connectivity difficulty. I have, in fact, I'll ask you one question of a case which I am already handling. But after Satvinder sir gives his initial exposition on the approval process for the approval process for any related party transaction. And certainly, please, audience, you will have to keep sending us questions. We have already received 40 questions so far. I am at the back office secretariat filtering the questions which we can ask in limited amount of time. Over to you, Satvinder sir, to share your views on the approval process, post which I'll start asking questions which I'm sure these expert panelists will be easily able to handle it. Sir, over to you.
Thank you. Thank you. In fact, am I audible?
Yes, you are audible, Satvinder.
Thank you. Thank you, Sudhakar. Thank you, Makarand and the NPS for setting the tone for this related party transactions. Thanks that, I was little late the inclusion for this, but couldn't make my presentation on this, and I was discussing because the time allotted to us was to speak for 15 to 20 minutes each, and then the question or session, and I was aware that what is happening, because the time by which has already been over, because by 4:10 I was to speak till 4:10, from 3:50 to 4:10. And I was thinking that whether I should make a presentation or I should speak extempore on that process, the audit approval. And then I thought that let me just talk about generally on that the process which is required, and I'll go one by one. You take my apologies that I'm not giving my PowerPoint presentation on that, but maybe times to come. But let me just generally speak on the process. And before the process, I think it's very, very important that we should look at the theories behind the related party transaction. That's very important. Thanks to Makarand that he has touched upon that what is in the ordinary course of business, what is the at arm's length transaction, and he has very rightly, and this was the discussion which I was talking about, that it is the act is talking about the arm's length basis, and we are just linking it with the arm's length pricing. Is it only that we have to touch? And thanks, Makarand, that you have very well elaborately touched upon even the tax cases and other things, and the arm's length transaction which we are talking about, and the definition part and the issues arising on that definition. Sudhakar has already taken it up. But when I'm talking about the theories which NPS started from the day, that is, it's not that all related party transactions are not bad, right? It can be in a positive way. You are saying that, it can be in the interest of the company and we can consider it. So if I look at it, there is, you see, Adam Smith, who was the you see, one of the pioneer in the economic theory of the related party transaction. He developed on the two things. One is that the theory of conflict of interest. That was the one that perceives and that makes it that the related party transactions are bad because it conflicts with the interest. There we are talking about that the directors are holding the position of the trustees. The directors are holding the position of as an agent. And when you are talking about, and when there is a conflict, when the conflict is that, okay, it is conflicting, that your priority comes more than that, that is bad per se. So that's the one issue. Then is the efficient transaction theory. When we are talking about, where we say that all related party transactions are not bad, sometimes it is good for that. And we talk about the efficient transaction theory. And let me tell you, as regard the approval process is concerned, how the theory has been developed either internationally, be it in UK, be it in US, be it in Australia, or be it in India. That has come out of that efficient transaction theory, which talks about the system. What is that system? The system talks about the disclosure and fair value transactions. You disclosed it, it should be at a fair length, what Makarand has talked about on that arm's length basis, or it is in the ordinary course, you are still doing it, do this thing. And then it talks about the special procedures which are required when you have to indicate the transaction, which I'm talking about the approval process. So before I again talk about that approval process, let me just take you that there are certain concepts which have been given. Unlike today, I was discussing one tax matter, though it's not my subject, but in relation to the corporate restructuring, whether the business laws will be available or not available, even if it is a related party transactions, or whether the unabsorbed depreciation will be available, because the corporate restructuring, as NPS said, that it is one of the area which is like in the blood. So I was just looking at not from the Companies Act and from the SEBI issues, but largely from the tax issues, because these are the transactions when you do, every person look at it that, okay, it should be tax efficient in nature. Now, on that basis, there are certain, so tax sometimes say that whether there are any concepts or not, whether that is there, but the concept in relation to related party transactions, which sometimes we say that it is a principles governing the related party transactions, where whether or not those concepts are codified or not codified. You see, there was a Colgate scam and 2G scam. If you read those judgments, probably you will come to know whether or not codified. The Supreme Court discussed those issues, because the issue was that whether there are any secret profits, be it not codified. So they have come to that level to say that you have, you see, observed directly, indirectly, in one way or other. One is that, okay, what is codified, and other things directly, it is not provided for in this thing, but they have gone extended to this thing to the extent of that there is a rule against that secret profits. You have to look at it. And that's very important when we will be discussing the approval process, how the audit committee has to behave, how the board has to behave, how the shareholders, what kind of disclosures we have to given. That is the important part which we are talking about. So that's the one principle which we are talking about, is the rule against the secret profits. Then we talk about the fair dealing rule. That is that if you are in control of an organization, you should not have the transactions which are in your interest, which we are talking about, and that will be done as a conflict of interest policy. Then you will understand. Then they have also given the concept and the principle of self-dealing rule, and where we are talking about the law of trusteeship, and if you see that the Trust Act, if you see that can trustee act with their trust because they are into a, beneficial? You can't hold it. So when I am saying I am a director, I am a related party, right? As a director, can I act? Then we are talking about the efficient theory, which has to put it for this thing. And then there is, last but not the least, if I look at the another rule, is the disinterested board rule. I think those are the principles which we have to think about. We have to work on that. And then we are talking about the overall. If I say now that the basics before I go, that from whom you have to take that approval, I'll take one by one so that at least we will have that provisions. One is there are provisions given under the Companies Act, and the Makarand and Sudhakar has already talked about that. We are talking about the Audit Committee, Section 177. We are talking about Section 188. We are talking about the definition which Sudhakar has talked about to subsection 76, and even the definition of relative of 277. I think if you look at even the definition of relative, probably still there are three layers above and three layers down, but as regard the concerned person, spouse is not included. That is where we are talking about. But sometime then the rule 15 and rule 6, I just noted down coming here. I thought that, okay. So that's a one part under the Companies Act which we are talking about. Put it in a one bucket, right? Under the Companies Act, how we are taking it is. Then we have to look at it where the listed companies are concerned. They are also subject to the LODR guidelines. When we talk about the LODR guidelines, and not only the LODR guidelines, I sometimes feel that even the insider tradings, again, those trusts, those principles and the concept would apply, where you have to look at it from the points of the insider trading regulations. And another one is the unfair trade practices. Even there also, where there is a, related party concepts coming, we should be aware of that, and we should be mindful of that issue. Then is it that, okay, we are looking at it as, I still feel that when we talk about under the IBC, Insolvency and Bankruptcy Code, they talk about the preferential transactions, investigations, which we have to see, and the related party transaction and the relative definition with the connected person under the IBC. It's a mind-boggling. I had given the check chart of the 3 layers above, 3 layers, and even with the spouse, it is coming something even you are not aware of the names of those which have been covered in the definition of relatives. Then last but not the least, talk about the tax. The tax, I would say, when we are talking about the related party transactions, you also have to look at it. Then sometime the dealing with the related party, it can take you out of the purview when we are talking about whether the expenses or the incomes, when the revenue says that no, I will not allow these expenses. So as and when there would be a disallowance of that expenses or disallowance of that income, right? Then even under the Income Tax Act, we talk about the related parties issues, which probably I'm just giving a brief overview, which I have to talk about. Now, look at from the aspects of the two aspects. One is the Companies Act, another is the LODR. When I'm talking about the Companies Act and the LODR, which is applicable, one, that even for the listed companies, please mindful that even the Companies Act provisions are equally applicable. But then there is a principle that if under the Companies Act, the provisions are little relaxed, and under the LODR, it is a stricter provision. There is a principle that the stricter provisions will prevail. You have to comply with that. It's not that, okay, you have to comply. One has to really look at it. So Regulation 23 in the LODR talks about those issues which we have to see, and that unlisted companies. So there is the one concept as such as the Audit Committee approval. So that is the one body which has to approve it. And with that amendment which has come, where Now the related party transactions have to be approved by the independent directors. We were discussing in the expert group that is it all the independent directors or only the independent directors in the audit committee? Definitely those independent directors. They have even put more onus on the independent directors who are on the audit committee than overall in that board for this, because the responsibility has gone to the independent directors. And I think it itself, once we are taking it, let me just tell you, probably we are on the verge of completion. The charter on that audit committee, which we have to see, and we'll surely will place it before the central council of the ICIC through once that is there. And probably I feel once even on that audit committee, which you will see that what could be the roles and responsibility of that and what process has to follow, what all the principles that has to be applied, you will see that, okay, this is again one of the best, I think, the document the members will have. And I must thank all the members of the expert group and the working group. And on that related party, I must thank the working group led by Sudhakar, who is, I think, in the last, almost in the 15 days, we have at least 8 to 10 sittings, even on the related party, discussing each and every aspect of on going through one provision, looking into it, what would be there, and probably you will have the amended guidance note on that related party very shortly on that part. But so one is the audit committee, then is the board. Again, on the board, which we are talking about, unfortunately, I would see that as regard the board approval is concerned, if Makarand, correct me if I am missed my understanding of this is as regard the board process is there, you are talking about the audit committee under 177, the board process only in respect of the transactions which are under 188, which we are talking about. But LODR is not talking about the board approval at all. The only thing is, it's not that you have to specifically approve it. But the way I look at it is when the LODR talk about the shareholders approval, it has to go through the board process and everything. So per se, I would say that you have to take it. The board will see and it will be recommended. But in the entire LODR I'm talking about, there is no mention as such whether there is a board approval, what you have to take it and other thing, what is in the rules under the Companies Act which we are talking about. And then is the shareholders approval. In the shareholders approval, again, we are talking about the Companies Act under 188, when there are threshold limits which have been given under the rules, which if we are going, then you have to take that shareholder approval. I'll come one by one for this. And then is the LODR. That's the approval aspect for this, which I'm saying. But there are two important things which I would say apart from that approval process is the examination process. That examination is by the auditors. As and when you are talking about that, okay, you have to pass the related party transaction, my advice is that please take the auditor into a loop also. Because he has to, you see, give it in a carol that, okay, this is the related party transaction. If he has made a reverse remark, then probably there will be a questioning on the audit committee members. There will be a questioning on the board, and particularly on the audit committee and even on the independent directors. So I think you have to have on the one side is the audit committee members, but my recommendation is maybe that my other panelists on this, whether they go by my advice or not, but I think it's better to take the auditors also. And sometimes the examination comes, I have seen when there is an inspection and investigation, besides the fact, and there are even the issues which I'll just share that example for this, is the issue with regard to the questions raised by SEBI. The letter sent by SEBI, that's an examination. Despite the fact that audit committee is saying and the board is saying that it is in the ordinary courts and it is at an arm's length relationship, but still the SEBI has come out with those notices, and then you are saying that, okay, the policy which you have said that no, you have to make it. I'll share that examination probably whether it is right or wrong in what way or the other. But I have seen the inspections, investigations at the SEBI level, and when the notices are coming and we are dealing with that, and then is with the inspection investigations by the Ministry of Corporate Affairs, even by the RD or by the DG. And they are also talking about the related party transaction and giving that report. And they are saying that despite the fact that you are placing all that board minutes, despite the fact you are placing that, okay, the audit committee has approved, he said we are not concerned about at all. So what would be the issues which will arise out of that? That will say. No, I'll just come on section 177 first. That's on that audit committee, which probably is and that audit committee which we are talking about is, there is a clause 4. Let me just take that. On that audit committee clause 4, this says that every audit committee shall act in accordance with this in writing by the board, which shall really include the recommendations for appointment, remuneration, in terms of appointment of auditors of the company. But review and monitor and auditors, and then is last is the 4, Roman 4 of 177.4. Approval or any subsequent modification. Now there is a difference, I will take it. Here it talks about the subsequent modification. The amendment in the LODR is the subsequent material modification. I'll deal with that. Which is coming to that part is with the related party, provided that audit committee may make omnibus approval for related party transaction. I'll come back again. So that is the proviso. Then it is talked about is related party transaction proposed to be entered subject to such conditions is provided further. There are 4 provisos. Provided further that in case of a transaction other than the transactions to in section 188, and where audit committee does not approve the transaction, it shall make its recommendation to the board. Now, which I am talking about is that it is only the transactions which are other than the transactions under 188 not approved by the board, it shall make recommendation to the board. And if it is not approved, so once that approval process is there, whether that approval process or whether that recommendation, if they have not approved, whether that recommendation is that whether to not to approve or they remain neutral and they say that the board will decide the recommendation to do, but it is in other than section 188 we are talking about in the proviso itself, which we have to see to it. Then is the issue which proviso is, and that's very important. That proviso 3 is important, which I would like to discuss for 3-4 minutes. Maybe provided also that in case any transaction involving any amount not exceeding 1 crore, mind it, rupees is entered into by director or officer of the company without obtaining the approval of the audit committee, and it is not ratified by the audit committee within 3 months from the date of the transaction, such transaction shall be voidable at the option of the audit committee. I'm taking a pause here. Now the question which is coming up is, what if the transaction is more than 1 crore? Then what would be the situation? But if the audit committee wants to, after 3 months, because here they have to approve it within a period of 3 months, then what would be the effect? And the effect of the word voidable. Now, let me just again talk about that there is a one doctrine of rectification, which is, you see, dealt with in the Maharashtra state mining. There's a judgment of 2006, and also which is upheld and reaffirmed in the Goa shipyard case, which is reaffirmed of that part, is where they said that the authority who has the power to approve any particular act, such authority can subsequently ratify the transaction. There is a, you see, that doctrine of rectification, and in the amendment, they have added that prior approval. So in one of that matter, which somehow the SEBI had levied a penalty that you had not taken the prior approval, they went to the SAT. SAT had said that, okay, they had the clause again taking note of that, the doctrine of ratification. They have, you see, passed in favor of the appellant to that extent. So SAT judgment. Then there is another judgment of the issue. I'm not making it is. So one, that if it is beyond 3 months, still that would be whether the audit committee and the board has the power to approve it or not, that one has to just look at from that angle. Then is, if it is more than 1 crore, and if that process is not taken, whether it is void or it is still voidable. That's another question which is coming up. Now, if you look at the Contract Act, so the void is talking about when there is a void with respect to when it is unlawful, the objects are unlawful, and it is without consideration. So there are certain sections, only certain specified sections where the transaction under the contract, it is seen that it is void, be it section 24, be it section 25, section 26, 29, which talks about the restraint of marriage, restraint of trade, unmeaning agreements, wagering agreements, agreement to do impossible acts. So these are the transactions which are void in nature. Other transactions are voidable. If it is voidable, can I say that despite the fact that I've taken it, my view, again, I have to take it up with the expert committee when we are discussing about that amendment, whether it is voidable. If it is voidable, then what would be the issue? And to some extent, the notices which have been received, probably we have to see on the concept of the void and voidable when we are talking about and dealing in this. Then comes the issues with regard to the board approval. When we are talking about the board approval, we are talking about only at the meeting of the board. As regard 188 is concerned, you can't have a circular resolution. It has to be by resolution at the meeting of the board. Now the question is, what sort of transaction you have to take it? One, if you look at 188, only those related parties which are under subsection 1A to G, that will come as in the realm of that related party transactions. If it is not there, that is going otherwise than in the audit committee for this, for that related party. And then there is a concept which I think Makarand has already put it. If it is at the, in the ordinary course of business and at arm's length. I don't want to deal more on that aspect because there are a number of judgments which are coming that what is ordinary course of business. You can take a reference from the income tax provisions. Makarand has already talked about on certain judgments, even on that Bharti and the Sasikala, about the judgments which he had put it. And probably those are the judgments and this. And then he has beautifully described about the concept of the arm's length basis and arm's length pricing. It is not only the arm's length pricing. If we are talking about in the ordinary course and there are certain other terms, you are going to give a better, you see, price on the face of it. But you are saying that, okay, the money will be paid after 10 years. Look at the discounting factor which will come in that part. And if you say the terms of the payment are such, which are not in the ordinary course, which normally the unrelated parties talks about, then can I say that it is an arm's length transaction, despite the fact that, okay, I'm saying that it is at arm's length pricing. And it is not only that, okay, we are talking about, and there could be many other terms which may not be beneficial. And then where the question of conflict of interest theory will come into that part, that has to be taken it up. Then the rule 15 talks about that what all that information has to be given to the board, be it what would be the name of the related parties, the nature, material terms, advance payment, manner of determining the pricing, whether all factors have been considered. That is what is written there. Whether all factors have been considered, and if you have not considered all the factors, you must give the rationale. Now, what all factors are required to be considered, that also have to be elaborated, and that the audit committee must look into that aspect and see that, okay, these are the factors. And this is what we are talking about, what audit committee has to go. Probably, I think the related party and the audit committee charter one will come. And when we are talking about the board process and the charter on the board and the nomination and remuneration committee, when we will deal it, and with this related party, and when we will, you see, synchronize all, probably I think all of us will be much more enlightened on that part. Then we are talking about the interested directors. The word is that interested directors shall not be present at the meeting during discussions. And invariably you are saying that, okay, we are saying that he excused it, probably from participating in the discussion, but he is still present in the board meeting. Is it what we are talking, or we are saying that, okay, now it's the independent, please others should go out of that? For that matter, let they not, you see, put any undue pressure on that independent directors when they are talking about. Or the other part which we have to see, that is the concept which has been given, and then we are talking about. Then is the shareholders approval. I think the shareholders approval is talking about under the Companies Act and the LODR we are talking about. The Companies Act have, you see, divided the concept, that's a 5A to G. We are talking, the one is supply of goods and materials, supply of services, buying, selling of any kind, lease, office or place of profits, and then they have provided a thresholds. Thresholds on a standalone basis of the turnover. And then when there is a buying or selling of any kind of that, they say the property, that's a 10% of the net worth is also given. But if you come to the LODR guidelines, right, you will find the provisions as regard the 10% of the consolidated turnover or rupees 1,000 crores. And then we are talking about the royalty payment, which that amendment from 2%, it has gone to the 5%. Sometimes people were saying that, you see, under the FEMA and the what would be the kind that, okay, they have taken out those provisions for this, but probably at last for that royalty payment, when we are talking about the increase, it presupposes that, okay, you have that power to give, but that again you have to see how much the royalty from the transfer pricing aspects you have to see, but that limit of consolidated turnover, the royalty has been there. So if I look at from the Companies Act point of view, when we are talking about the shareholders approval, only those related parties who are party to the contract shall not vote. That's coming out of the MCA circular of 17th July 2014. But if I look at from the LODR perspective, all related parties, whether they are parties to the contract or not, they will not vote. All related parties and subsequent modifications, I had said that prior approval. Then is that because of that amendment, which I think Sudhakar has already covered it, what about the existing material contracts? On the one side, it talks about that the LODR guidelines will be applicable to the transactions which are between the for all prospective transactions. But what about the existing transactions in the 8, which they talk about, is that you have to place it for that approval in the first shareholders meeting. You have to see that has to be given. But as regard the exclusions are given under the LODR, that exclusions are restricted, unlike the exclusions under the Companies Act 188 on arm's length basis or in the ordinary course. But if you look at it from the LODR perspective, there is nothing about the arm's length basis or in the ordinary course. It talks about that if it is a wholly owned subsidiary and whose accounts are subject to consolidation, or when there are two wholly owned subsidiaries, ultimately it is to go to the consolidated at one place again. So those are the exclusions which have been given. So probably I would say even on the related party subject, which I would say that how it has to be dealt, how it has to be seen, the provisions. It is from when I see the notices from this, my advice is that not look at only the substantive provisions, look at the intent, look at the spirit behind this, look at the theories and the principles governing related party transactions, which are very, very important. I think we need some time for that question hours. And with this, I rest my case, I would say, to that extent. Thank you, ICSI, for giving us that opportunity, though it was not there, but maybe I thought that let me jot down certain points. So I asked Makaran, yaar, maine to PowerPoint banai. Are you giving the PowerPoint presentation? He said that okay. I rushed to the office for the last 2 hours. I was just making certain notes. I thought that I can make certain notes and probably I'll share it when we will have that expert committee and we'll discuss it more on that part. Thank you so much for giving me the time to present my thoughts on that related party transaction.
Thank you. Thank you, sir, for detailed exposition. Many questions I can see we have received. Few of the questions may have already been covered. Still, I'll do one thing. I'll request all our learned 3 panelists to give the answers to the questions we have received. In fact, we have already received now around 60 questions, maybe more. Secretariat is sending more questions to me. So I'll quickly start asking briefly. I think and one can supplement. Otherwise, I'll try to be brief and same, I'm sure our panelists would also do so that we can answer as many as questions we can. Sudhakar sir, will a preferential, and I'm starting from bit simpler questions which I think have already been covered, but since the members have asked, I'm deliberately asking so that members will get that clarity. If I ask that question, they feel satisfied that yes, we have asked the same question, although briefly it has been covered in a way. Will a preferential allotment of shares to a related party be treated as a related party transaction under 188?
That 188 comes into picture only for sale of goods. Otherwise, for issue of securities, 188 doesn't come into picture at all. So before issuing any security, it is only you require, I mean, that is also to a related party. You have to have 177 approval and not 188 approval. However, in case of listed companies, this is entirely different because the listed companies are concerned, you have to have your audit committee approval anyway. Now, under this particular listing regulations, the issue of what's called as the specified securities on preferential basis in compliance with ICDR, they are exempted from related party transactions.
Perfect. Makaran sir, will providing corporate guarantee to the bank by the holding company for a loan availed by its subsidiary attract the provisions of 188? And if you can share from both perspective, listed, unlisted.
Yeah, so as far as listed is concerned, it's again, Sudhakar sir had already highlighted that it is not a 7 listed transaction, it is any transfer of resource or obligation. And definitely, whenever there is a security or guarantee, there is either a sharing of resource or definitely an obligation which we are undertaking. And therefore, LODR is concerned, audit committee approval is necessary. And if it is material, even shareholder approval. As far as Companies Act is concerned, again, 177 is much beyond 188. And therefore, it is undoubted that you will require approval of audit committee for sure. Board approval anyway is required because it is anyway regulated under 186 or it may be regulated under 185. And 186 specifically requires us to have unanimous approval of board of director, where if there is an interested director, they will not be voting. So,
in fact, sorry, go ahead, Makaran. Go ahead.
No, so I am saying that 360-degree analysis is essential characteristic of a company secretary these days.
Okay, because see that when we were discussing this issue in the working committee, that one issue has come up is that does it fall under the definition of service? So the answer to that is that if it is a one-off transaction, you cannot say that you are in the process of rendering services. If your company is an NBFC company or a banking company like that, and if you are doing it, maybe you may fall under the rendering services, but otherwise it won't fall in that thing. Whether it is personal guarantee, whether it is corporate guarantee or whatever it may be. One-off transactions, they don't fall under the 188. Only thing is, in the previous question, the NPS, I want to add one more thing also. Though before, at the time of issue of securities, though 188 doesn't come into picture, but once the allotment takes place, any kind of sale of shares, not other securities, only shares, because they are falling under the definition of goods under the Sale of Goods Act. And recently, somebody has again raised a question that shares are not goods under GST Act. So which act we have to take? This we will discuss in the expert committee. I have parked that particular question. Very interesting questions have come up in the working committee discussions. Yes, under the GST, it is not so, but under the Sale of Goods Act, it is so. Ultimately, what call we have to take, that we will discuss in the expert committee and will deal with appropriately in the revised guidance note. Thank you.
Let me supplement, Sudhakar, when we are discussing two aspects which are coming. I think that's important. The questions are much more, but those are the two aspects which are coming out of it. One is the goods. The question of goods will arise when something is in existence. When I'm saying that, okay, if that is an issuance of shares, there is no question of that goods. The goods will arise later on when that is there. Probably you will be out of that provisions for this. That's one. But the larger issue which Makarand has raised, and probably I had to answer it, and I was taking up that issue, I missed in my presentation, which I had to give it. And that was an interesting, and probably it is relevant for all. The question came to us of that listed company was, and I had to give that opinion, and I charge a reasonable amount on that. But let me just share with that is the personal guarantee. When you said that, okay, whether it is a service or not, that's one. But if you look at the definition which you have dealt with, which talks about the transfer of resources, and it also talks about the obligation. And probably I discussed with Makarand, I discussed with a couple of others on that expert committee that, okay, suddenly I'm raising a loan which is becoming more than the threshold limit, and I have promoters for the benefit. Again, it's an efficient theory of, you see, the transaction theory, which I'm saying it is for the benefit of that company. But the view which SEBI has taken, the view at this, because there is nothing that, okay, it's a related party transaction, which talks about the related party transaction. They said that, okay, it is going for an obligation. What is the obligation coming to? Because if the guarantee got it on that, then that becomes a guarantee and you have to give. I think that's a view which SEBI or Makarand, we were discussing all that in one of the matter that has been taken. No guarantee, if it is to be evolved, that means under the Contract Act, there will be a right of substitution. And if there is a right of substitution, then you will claim against that company. The personal guarantor will come and claim against the company. The company had taken loan. I had given the personal guarantee. No, I am paying to the banks, because otherwise the transaction is between the guarantor and the bank. The party is only a confirming party to that extent. But the question is of that obligation, which tomorrow the company cannot say, no, I have not undertaken that obligation. And probably we discussed, and when I thought that, Makarand, can I do like this? And probably this is where I'm saying is that drafting of the contract, even of that guarantee, when that obligations have to come, becomes much more critical. And probably when we put that drafting of that agreement, I said that, okay, why not you draft agreement putting all those caveats and conditions? And then probably when they came to me after that, then I said that, okay, it is not applicable. So that's an important aspect which I thought that I can highlight.
Perfect. Thank you. I know how difficult it is. Only I would know how difficult it is for me to hold my horses, because the discussion is so engrossing, and I deal in this subject lesser than how much it is dealt by the other three panelists. But, I'll still hold my horses, continue with the questions. So that will be whether it will attract 188 and Regulation 23 of LODR.
I don't know to whom the question is, but I'm not able to hear your voice.
I couldn't hear your question, NPS.
Yeah.
The question was, am I now audible?
Yes.
Paying interest on loan to a related party, whether it will attract 188 and Regulation 23.
Okay. If I have to take this question, one thing I want to clarify. 188 is concerned, 188 is not applicable per se to the financial transactions. Whether it is investment, whether it is lending, whether it is borrowing, giving guarantees, providing securities, and also financial transactions, if you see under 188 subsection 1, they are not there. This I am talking for the unlisted companies. So definitely they will not fall under the 188 unless until that particular transactions are coming in the definition of services. It is a different thing. But most of the times it won't come like that. Then definitely you have to go for audit committee approval. In case of listed companies, certainly this will fall under the RPT transaction. As Swatinda rightly mentioned, that listing regulations talks more about the audit committee approval and not about the board approval. So anyway, that prior approval of the audit committee is required as per the listing regulations and as per the Companies Act also. So financial transactions, one should not worry as far as 188 is concerned. Makarand and Satvinder, you may substantiate it.
Oh, so this is the general practice even. However, we have to be watchful about what regulators' view which will emerge. Service, as we have been discussing, no, we can basket all of this NPS under one, and we can close with this respect to guarantee, loan, share. This is all getting discussed in these two questions.
Even the
service is not defined under Companies Act. It is defined under Consumer Protection Act. It is defined under GST. It is defined under monopolistic. So every act has its own mandate, and every act has its own deliverable. And therefore, as far as Consumer Protection Act, it says that if you are not charging anything, then it is not a service. But if you apply that principle under Companies Act, it will be disaster, because that would mean that I will render for free to a related party, not charge him, and then I will be out of related party transactions. So we cannot copy paste these definitions. These terms has to evolve, and as of now, we may take this view as to whether it is your business of rendering this service or whether it is not your business of rendering this service. However, is it the intention of the law? I don't know. Because if we keep providing guarantee or security or giving loan to a related party out of 188, how regulator is going to look at it is a big question mark, and that we'll see as adjudication process evolves.
Let me add, I think since Sudhakar said that this, Makarand, if you look at on that service part, I'll just give you the example. What is the definition? So 188, definitely it will not come. I will say that, okay, it is not coming because it is on that specified A to G, which we are talking about. But 177 audit committee is there. That's number one, which we have to see. The other question which I'm saying, that the regulation 23 of the LODR, what we are talking about is which we are saying the resources, services, or obligations. Again, obligations, and that is from which side, whether it is company side or another thing. That's another question mark. Then it is coming up is, now when you have very rightly pointed out, and you have really touched the chord of that. You can't put it to this thing. Like I was handling one matter, and they said that, okay, I have to agree that I will not make compete with the company business for any transaction which was going. Now, one side was that, okay, I should charge certain things because it says that under the goods and service tax, when you agree to do something or not to do something, it is also a service and it will be subject to service tax. That is where, when there was this, there was a definition to that. Now, but if you look at the LODR talking about, they says whether or not that payment has been done or not, right? But it is a service. So you can't put it. Ultimately, you have to see that theory, which I started with, that is that whether it is a conflict of interest theory or efficient theory. I think that's very important, and then we have to go with the principles. All Perfect. Those questions, ultimately, you have to govern with those principles and theories which are there.
Perfect. Sudhakar sir, now although it's maybe repetitive, but from a different perspective, investment made by company under gratuity trust, whether RPT?
Gratuity trust, no.
Loan given to director and company secretary as part of employee loan scheme, whether RPT.
See, loan given to director, I presume that it is an executive director. And similarly, of course, company secretary, anyway, he's employee. If it is as per the loan policy of the company at the same rates what other employees are also getting that loans, then it is not an RPT.
It will require audit committee for sure. No?
Yeah.
Of course, it requires audit committee approval. See,
let me put
per
that
se, let us take it like this. Any transaction with a related party, audit committee approval is required. Only we are examining board approval is required or not required.
NPS, I think each question you can continue to debate. Then the time is already over, but let me just put it. The same issue came, which we are talking about the gratuity trust which the company has made, was the trust created for the CSR purpose, where your directors would be the directors or independent directors would be there, whether it is a related party. I think we were talking about the discussions on that related party, even on this and even on that gratuity. I think it may not come under this, but we have to see from, again, 23 relevance and to see, I think that's a question which probably we have to deal with in the working group and come out with this and okay, how best, and again, a theory concept we have to take up.
Because if it is a gratuity trust, we have to look at who are the beneficiaries.
Yeah.
And because it is a pass-through, trust is not a separate legal entity as far as.
Very right.
Very right. So that it all depends. Yes, no answer is very difficult. Yes.
In general, one can say that, though you cannot say specifically, but employees, I mean, the gratuity trust is beneficiaries are all mostly employees only.
Right.
So that's why one can take a call like that per se. But of course, whatever the views we are expressing, these are based on the questions, what is coming. But don't take it as if it is a gospel truth or gospel opinions. And one has to examine every issue based on the facts and figures.
Correct, sir. Mobilization advance to a related party.
This question is to whom, NPS?
No, to all the every question is to Sudhakar.
All now because now I've left addressing it because the questions are so.
He's saying there are 60 questions and we will answer. I think it will take another 2 hours.
No, I think there is no point of taking up the financial transactions because you put it into one bucket and then leave it there. Otherwise, mobilization advance and then some project advance, it will be a number of things like that.
But I'm tempted to speak, Sudhakar. Mobilization advance is for this. There is some underlying contract which is for providing goods or services. And mobilization advance standalone is a transaction, but the contract, if it is an unlisted company, and 188 talks about contract, whereas 177 and both LODR talks about transactions. So as far as if the underlying contract is for providing service, that first of all you need to get it approved. And then the question of mobilization advance will come.
And then again, the ordinary course of business and arm's length is also there. That exemption, if you are able to get it, nothing like it.
If it is disproportionate to the practice, then it will not be an ordinary course.
Correct.
So NPS makes just one thing because we have already exceeded the time. Probably the 1 or 2 questions which Makarant and Sudhakar, we can pitch in for each of the questions because it is good that that would be a good crowdsourcing, Sudhakar, which we can definitely consider all questions. And probably then we can make it as part of our guidance note. If there are repetitive, then we can club it. Makarant, is it a good way to put it, and then maybe that?
I think we can for 5-10 minutes more. Unless
please proceed.
In fact, I was feeling by the time I will start asking questions, the number of participants will reduce. But all credit to all the 3 panelists. The number of participants have increased. And thanks a ton to the 11,000 participants who are presently logged in. So when I started question answer, it was around 9,500 because I'm getting continuous message from the secretariat. Presently, it is 11,000 participants. So I think they are interested. Let me continue. Although I had to go back to the program here, but let me. Sudhakar sir, related party transactions between 2 government companies are exempted. Is it necessary to place related party transactions before the audit committee and the board for information?
Yes, they are not exempted from the audit committee. They are exempted from the board approval. So you have to place it before the audit committee and seek their approval.
Better good corporate governance, we may say that yes, you may place.
Even otherwise also it is required. Because transactions between wholly owned subsidiaries are exempted from the audit committee also, but not the government companies.
Right. Satwinder sir, can approval of the audit committee to the related party transaction be granted by passing of resolution by circulation?
Oh, I think again, you have to see the intent for that. You see, in the board meeting, as I mentioned, that in the board meeting, it has to be by way of a resolution. Now, probably there is no guidance, statutory guidance on this, but principle is that, okay, there should be a meeting of minds. There are certain agenda items you have to discuss because the information has to be placed. And if I see the intent behind that, okay, it has to be board meeting. And when we are talking about the audit committee, you are circulating to the audit committee. And that too with the independent directors, I think it would be important that independent directors meeting should happen to that extent, and then they can pass it.
Secretarial standard mandates audit committee approval at the board meeting.
Makarand sir, a joint venture developer company, 3 partners, joint hands. My question, I'm skipping the other questions. 3 partners, 3 shareholders, 3 directors.
Individuals.
Join hands, 3 individuals. Join hands, put money in a company. Company buys land, contiguous lands. Licenses taken, 3 licenses. Now they want to do their own business in their own companies. So the company is selling the land to all the 3 shareholders by passing a board resolution. 1, whether it's a related party, and 2, any other impediment you see, whether it's a related party or the transaction is on arm's length. Let me tell you in the beginning. The question is whether it will be ordinary course, because the ordinary course of the company otherwise would have been to deal with this immovable property, land, and maybe build project and then sell it. But whether it will be considered as the ordinary course when the land itself is being sold to the shareholder.
So it will be very difficult to say that it is an arm's length. It will be very difficult to say that it is an ordinary course of business for sure. And even if it is at arm's length, it will be not in the ordinary course, and you will require shareholder approval minimum. And you were non-related, so they can vote for each other. That way they can do. But the risk which they have is that under section 166, the duty of the director is to take care of all stakeholders, including creditor, government, lender. And therefore, if there is any other stakeholder who raises a whistle, then this transaction can be a preferred transaction, and there can be larger troubles apart from related party transaction. As far as related party transaction, disposal of property, not in ordinary course. Again, ordinary course, I am assuming that you are not in the business of dealing in land. You said that the story which you narrated, there was specific JV, 3 properties acquired, 3 properties getting disposed of, definitely not an ordinary course of business.
In fact, there is one question in the chat box more or less related to this. A company is purchasing assets and liabilities of another firm or company, whatever it is, on a slump sale basis. Question is it in the ordinary course of business? So again, the same thing, you cannot simply say yes or no for that. If you are already in the particular business and furthering that business, if you are acquiring that business on a slump sale basis, maybe it may fall on the ordinary course of business. Otherwise, if you are doing it for the first time, that company has not started even its business, but you are going for a slump sale, you cannot say it is in the ordinary course of business. So as I was mentioning, that every issue you need to examine based on the facts and figures. Thank you.
Whether receipt of dividend by holding company listed on equity shares held by it in the investee listed company is a RPT for holding company?
There is no decision of the listed company. This is a decision of the company which is declaring dividend. And therefore, although there is an obligation for the company to pay that dividend to the every shareholder, including the holding company even, but it is, as far as Companies Act is concerned, it is definitely an ordinary course and arm's length, because it is first of all available to all the shareholders.
Listing regulations anyway, they are exempted declaration of dividends. The RPT.
Correct. Satwinder sir, will payment of commission to non-executive director be treated as a related party transaction? And in fact, should they vacate the room when this item is taken up in the board, or they can participate also?
See, again, the same thing. When you are making a payment of commission to the non-executive or independent directors, non-executive and independent directors, it is to be approved by the executive directors technically, because they are the non-interested. Quorum has to be formed. Number one. Number two, is it a related party transaction? It may not fall in the in the 188, again, the same presumption, ordinary course of business and arm's length. But definitely you have to take audit committee approval under 177.
And even the nomination remuneration committee, 178.
Yeah, of course. I mean, those compliances where we are confining ourselves.
You have to see, and probably, you see, being an independent director in certain listed companies, I always excuse. And then again, the question is, it in the ordinary course and at arm's length, because the law also provides certain threshold limits, right? That is the one part that, okay, you have to pay this up to a particular amount. And if it is at industry trend and it is below that, and thinks that the committee can take that part to that extent, then the audit committee can also approve to it.
See, one more thing I want to substantiate this with another point is that it is in the ordinary course of business because you are making payment of commission to the non-executive directors, number one. Number two, sometimes it may so happen you are not paying equal commission to all the directors. For some directors, you might be paying more, some directors, you might be paying less. But still, we may be able to establish that it is at arm's length. But you have to give the rationale properly, why you are paying some extra commission to some directors and not to other directors. That is to be minuted also, so that tomorrow you will be able to establish that it is at the arm's length basis. Some rationale should be there for that.
One just last point, NPS, the question was whether we should not attend that meeting. And if that was the question, I think Secretary Standard is very clear that if the transaction is under 188, whether it is ordinary course, arm's length, that's not a subject. But whether the transaction is with a related party, then the director should not be present at the meeting, is my understanding. And similar provision is there even under Companies Act rules, where they say that the director should not be present at that time when this particular discussion. So if it is at the board meeting, definitely board will discuss about this commission payment. He should not be present.
Sudhakar sir, whether contribution to a society for CSR purpose in which director is a president or member is a related party transaction, will it require audit committee approval? Last is important, whether it is to be entered in register of contracts arrangements under 189.
It's a big question. And number one. Number two, let me say that by merely he is a president of the society, he will not become a related party. Okay, that because in case of societies that 25% of the contributions, if it is receiving from the listed company, that it will fall under the definition of related party. So one has to see the definition of related party, whether it is so or not. Then second question comes about, again, the same thing. Is it in the ordinary course of business or arm's length? Then accordingly, 188 provisions are to be complied with them. Of course, definitely 177, it is advisable to comply with, take the audit committee approval by abundant caution also. In fact, I always say that per se, better to route that through audit committee, every transaction with a related party, so that you will be safeguarded, both listed as well as unlisted companies also.
Can material related party transactions of year 2021 be approved by shareholders in the AGM to be held in September 22?
I think this prior word came from 1st April 22, but this prior word under Companies Act is there since beginning. So if it is about regulated under 188, then prior anyway is there. Otherwise, prior under companies in LODR came in 1st April 2022. So it will not be, LODR is not, that amendment is for the transactions after 1st April 2022.
Oh, Makarand, again, that issue, again, I'm saying the doctrine of ratification. That's the important aspect. Do you want the default to continue, or do you want that, okay, if you have that doctrine apply?
There are two issues. One is that if the shareholders do not approve, then the validity of the transaction.
Yes, that's what I touched, void and whatever.
And even if the shareholders or audit committee approves it subsequently, whether it still remains a non-compliance. So these are the two aspects at which we have to settle it.
So this is,
in fact, sorry, go ahead, Satinder.
no, this is where I said that I touched upon the question of voidable and void. You can't have void ab initio or a void. It is not that, okay, merely that procedural lapse will not take you that, okay, the transaction itself is void. So that's my personal opinion. Again, it's not I institute opinion being into that or the expert group on that, which we are just making. That's my personal opinion, which I've just made.
See, one thing what I would like to add is ongoing transactions, which are falling under the definition of material related party transactions. Under 23(8), they require shareholders approval. This was there in the beginning also. That point of time, SEBI said that this approval can be obtained at the next general meeting of the shareholders. So accordingly, because 23(8), we are taking inference from the beginning and the SEBI LODR 2015, we may take the inference of that particular circular also. So if any transactions, ongoing transactions prior to 1st April 2022, if we are going to the shareholders approval in pursuance to 23(8), we may go to the shareholders at the forthcoming general meeting of the company. It may be EGM or AGM, whatever it may be. But if it is a fresh one, then obviously you have to have prior approval of the shareholders. You cannot take shelter under this particular regulation.
Right. Sir, next. Is the concept of omnibus approval of RPT applicable for shareholders approval also?
This Makarand and Satwinder will say about this particular circular is.
This circular, I think, this whole concept of omnibus came. First, it came in Companies Act and then it was adopted under LODR, if I'm not wrong. And that was for audit committee and not for shareholders. Actually, shareholders never approved one-to-one transaction unless it is a specific transaction like disposal of an undertaking or acquisition of some entity, which is a specific transaction. Only then shareholders approve. Otherwise, it is always a general approval up to a particular limit, subject to certain terms and conditions. Then it is it was always like that. It is only because of that, I think, 8th April SEBI circular, which has came out saying that if you are taking omnibus approval every year, you have to take that shareholder approval. This was raised by proxy advisors earlier many times that you cannot keep such omnibus approval for perpetuity. You should have some lifeline, say 3 years, 5 years, 2 years. Now SEBI circular, now whether that was an intention of SEBI, I'm not sure, but now that has become industry practice that every company is trying to take it year on year.
But I think omnibus approval, Makarand, is only an exception given to specific approvals. I think that's where we are talking about. Its principle is that you have to take it before the audit committee, and wherever it is required, you have to go to the board under the Companies Act, and if it breaches.
No, it is about shareholder approvals.
I'm saying if it breaches the threshold, you have to go to. I'm just giving the concept of this thing, but omnibus approval is only when we are talking about the repetitive transactions and other things, and you are taking it up, and in the those transactions, because as regard the audit committee is concerned, which we are talking about, not at the shareholders level, which we are talking about.
I think, in fact, to say, as far as omnibus approval is concerned, 177 subsection 6 is giving it clearly what are the transactions which can be approved by the audit committee on omnibus basis, subject to the criteria recommended by the audit committee and approved by the board, blah, blah, the procedure, entire procedure is there. Suppose out of that omnibus transactions, if any transaction is falling under the material related party transaction, it has to go to the shareholders. It is not omnibus. It is only a specific approval only they have to take for that particular material related party transaction. Till date, I couldn't understand what is meant by this omnibus approval of the shareholders. Of course, we need to discuss this in the expert committee, and we have to deal with this in the guidance note also appropriately.
So, Satwinder sir, you may answer this since you are independent director. I know in presently even in couple of listed companies, how to pass resolution for increase in payment of sitting fees when all the directors are interested.
Where we are talking about the sitting fee in a way that You see, particularly if you are taking it to the NRC and then to the related party transactions. But Makarand, what is your view on this? Because
so by law, you require audit committee approval
Audit
because it's a
committee
related party. But audit committee, nobody would be able to participate 99.99%.
Yeah.
And they would say that this is a transaction which has come to us, but none of us can vote. And therefore, we refer this matter to the board of directors without approving or recommending.
No. So is it that okay? No, I'll say that because it's a sitting fee for a particular director, then I'll say you go out. I'll approve that for him, and then as
You see, the only thing is, if in that audit committee, if the composition of the audit committee is in such a way, the executive directors are there, say more than 2 executive directors are there, they can form a quorum, they can approve the sitting fees there.
Because particularly on that executive committee, the executive directors can take it up, and you see the other directors go out.
This will be the only exception to the rule which says that all related party transactions should be approved only by independent directors.
Yes.
Correct.
And
Sir, salary paid to our member, like earlier it was being paid to one of our panelists earlier, and that is being shown under the related party transactions in the financial statements. Is this practice correct? The question is on
to whom?
To the company secretary of the company.
Yes, it is.
Disclosure of
related
activities.
party.
Yeah.
He is a related party. He is a KMP. He is a related party.
And disclosure is required in the financial statements.
RPT policy duly adopted by board exempts certain transactions for approval by audit committee, such as remuneration, etc. Would it still require approval of audit committee?
I don't think audit committee can give such exemptions which is not beyond its whatever law has given them the responsibility of the fiduciary. Whether they can delegate it further, I have my own apprehension. They have to discharge it themselves. This is the fiduciary responsibility.
I think we will have to stop. Or maybe there are a few more questions, in fact, many more questions, but I think we'll have to put some time limit somewhere. Maybe I can ask last 2 questions. Sir, I'll ask this question to Sudhakar. Let me ask this question. Company A holding 49% equity shares in B. There is one common director, Mr. X. If the director, Mr. X, is also in receipt of commission from company B, which is within the limits under the Act, will the same become a related party transaction for company A?
It won't be, because the transaction is between the director and the company. So that's why it is not between the 2 companies. So it will not fall under the related party transaction. But as far as that company is concerned, for them, it may be a related party transaction with a related party, and they have to get the approvals of their audit committee and all.
Makaran sir, legal position on applicability of 188 1B to buyback in a private limited company.
So buyback is approved. So there are 3 things, principles. One is harmonious construction, where stricter will prevail. Then special versus general. And the third is a code. Whenever there is a particular provision, is a code in itself, whether the other provisions will apply to it or not. And this was dealt with by Supreme Court when they were discussing whether money lending acts of local act will be applicable to NBFC. And I feel that buyback as such is a code in itself. It talks that it has to be offered it has to be offered on a proportionate basis only. And therefore it takes care of arm's length to a greater extent. They have certain more thresholds like debt equity ratio should not be so much, auditor to give certificate, and so on and so forth. And therefore, I feel that it would not be covered under 188.
Because already the disclosure has been given, it has been offered to all.
Offered to all.
And it is the choice of the shareholders whether to, subscribe to that offer or not that offer. Because it's not that, again, it is not that, somebody is pocketing the interest at the back of the other shareholders.
Absolutely. This is by law and it's a code in itself.
Now, this question generally Satvinder sir asks in every interview. I am asking now deliberately not him, but Sudhakar sir or Makaran sir,
I'm not preparing for the interview.
leasing of property, leasing of property of any kind, as we know, is covered in 188 1C. Whether leave and license agreement will be counted as a leasing.
Leasing and leave and license is entirely different.
If
And leave and license doesn't fall under the leasing activity. So leave and license is not covered according to me under 188.
But
Perfect.
I think again, NPS, I'm saying this is a very, very fine distinction between the lease and leave and license, right? You have to really look at the document and other things. Merely you are putting on the document leave and license, and the contents inside are all attributes are of the lease, then probably it will have a problem. Merely you see,
then
I'm
it's a
saying that,
service.
okay.
Then
So,
it's a
okay.
And whether it will become service.
Yeah, for commercial lease, yes, definitely. So
we can stop. I think the
So
questions are
NPS, before you conclude, only one thing I want to tell the participants. At the end of the day, it is the company secretary and the management knows what is what. When you are examining the related party transaction, whether it is in the ordinary course of business, arm's length or not, whether it is falling under the section 188 or not, to a large extent, you know it. But sometimes what happens is to overcome the compliances, if you try to camouflage the transaction, just like Satwinder is mentioning, suppose if you give a color to the lease agreement as a leave and license and say it is not applicable to me, then you will be in trouble. Same is the case that which is not falling under ordinary course of business, but you are trying to say that, yes, that means what? A cat is drinking the milk by shutting its eyes, but nobody is watching me, then tomorrow you will be in trouble. So what I'm trying to say always is when dispassionately, if you examine a transaction, you yourself will come to know what is what is not. Based on after that, take a call. Whenever you are taking a call, as I was repeatedly mentioning, I always say that have proper documentation under what contest you have taken such call, so that tomorrow when you are taken to task by the regulator, as a KMP, you have to insulate yourself also. As well as, of course, you have to insulate your management also, not only yourself. Thank you.
So what Sudhakar sir is saying is that, whenever you are posed with this question, you introspect, look at the section again, take a deep breath, and then try to take a call which is dispassionately, as you rightly said. That's how I argued a matter where I said the agreement is nothing but subterfuge. The question was whether security deposit is a financial debt or operational debt. But the agreement was drafted in such a fashion that it was nothing but a subterfuge. The transaction was shown something, but it was nothing else than a mere paper. So I think it's already 5:30. The secretariat is also now sending me message that we can have another session sometime again. Thank you all the panelists. Thank you all the audience, large number who have attended today's program. I'm sure the questions which have not been answered will be still taken up by the expert group. And whenever they discuss this subject, and they discuss so often, I wonder, I don't know how much time and how they take out so much of time. I have seen Satvinder sir doing these discussions on virtual mode, obviously, so many times, late at night, early in morning, on Sundays. So this intellect hunger, which Sudhakar sir mentioned in the beginning, there's a Maruti ad. If you see the Sadar boy, driving his small car, father says, "Oh, beja beta," and the boy says, "Ki kara papa, petrol khatam hi nahi honda." And this petrol is that intellect, the hunger for intellect, hunger for. That's how I say when I see Sudhakar sir, who recently, although you don't look that old, honestly, who is superannuated from Reliance. But whenever I meet you, Sudhakar sir, I always feel that age no bar, learning bar lagatar, and it goes on forever. And whenever I meet Makaran sir, I always feel a quote of Gurbani, which is so apt, that Vidya Vichare te Paropkare, which means to disseminate knowledge is the biggest paropkar. And I think whatever I say, whatever I have learned is from my mentor, Satvinder sir. Thank you for sparing your valuable time, all three of you. Thank you, Secretariat, for ensuring that we all deliver the best. Thank you, all the participants, for joining in large numbers. We look forward to your suggestions, making these sessions more interactive, making these sessions more worthy for you. Keep guiding us, keep blessing. Thank you.
Thank you.
Thank you. Thank you for giving us.
Thank you, ICSI. Thank you.
Thank you. Thank you.